So I think the thing that makes our approach unique is first to focus on valuation. So merger arbitrage is an interesting asset class in that you don't think about valuation in the same way that you might another one. So for equities, you might look at a PE ratio. For asset classes, you might look at a 7-year forecast. For merger arbitrage investments, the whole ballgame is around the probability, the likelihood of any particular merger closing or breaking. Now, you might not think of that through a valuation lens, but we really do, because when we think about investing in any individual merger spread, probability is our pricing mechanism. We're going to handicap the probability, the likelihood of any individual event happening, and then when we find an opportunity where the market is a little bit more pessimistic than we are, those are where we find our investments. The second piece is time horizon, which is that we are in this game for the long term. That tends to be a differentiator within the event-driven asset class because you have a lot of folks that are inherently more short-term focused. They're trying to generate next quarter's numbers, next year's numbers. Our approach, again, focusing on those probabilities, really gives us the ability to take that long-term horizon. So if an individual deal breaks in a given year, it's not a crisis. It's just the nature of how things occur in the asset class. And so when we take that long-term perspective, we can take the types of bets, we can make the type of investments that other folks in our asset class we don't think are as able to do. I think one of the interesting things about the timing of event-driven, particularly looking at it today, is that the opportunity set in event doesn't tend to have as much volatility as some of the other asset classes you might be looking at. So if you're looking at equities or fixed income, event-driven has opportunities where sometimes it's a little better, sometimes it's a little worse, but we think the consistency is actually kind of the key. My partner Doug, one of his main phrases after being in the business for over 2 decades is that there's always something to do, and we find that to be particularly true in our asset class. We usually don't have a particularly hard time finding things to do in our space. What is interesting about event-driven, and particularly the way we practice it compared to the other asset classes in the world, is that opportunity set isn't as volatile. Equities might whip around a lot more, fixed income even, than our opportunity set. So if you're looking at the investment opportunity today, if you're looking at stretched equity valuations in a number of portions of the world, event-driven might be a nice place to be. Similarly, if you're worried about the potential for drawdowns in the equity marketplace, our correlation profile we think is particularly attractive. So the interesting thing about event-driven as an asset class, we think, really rests on 2 primary appeals. The first is the ability to generate good long-term real returns, and the second piece is the ability to do so without a lot of correlation to the other things that have gotten you those returns over the long term, in particular equity and fixed income. That's what we think the real selling point of an event-driven strategy is, and why it can play a really useful role in client portfolios.